Japan's 30-year bond just hit 3.38%, the highest yield in the entire 150-year history of Japanese government debt. October CPI inflation report, officially cancelled, wiped off the calendar forever. Atlanta Fed GDP now just upgraded Q3 to plus 4.2%, hotter than any quarter in the 2021 stimulus binge. Rate cut odds swung from 45% to 80% in 48 hours after Powell's number 2 opened the door. Bitcoin topped 126K with zero euphoria, flushed to 80K with negative funding for the first time during the pullback, typical mid-cycle reset. This is Magic Money Macro Episode 2. 6 pillars. Deep dive. No fluff. Let's roll. Japan. The bond market just declared independence. 30-year JGB yield closed at 3.38%. That's not a blip. That's the all-time record. The Bank of Japan owns 53% of every outstanding bond, spent 15 years pinning the curve wherever they wanted, and quietly abandoned yield curve control in October 2024. The market took that as a green light to revolt. 10-year yields doubled in the past 12 months. Super long 30-year and 40-year bonds are now pricing in 150-200 basis points of cumulative BOJ hikes over the next 3 years. Japan's debt to GDP sits at 255%. Interest expense is on track to surpass defense spending and education spending combined within 18 months. The Ministry of Finance is already panic printing a 21.3 trillion yen supplementary budget just to keep the lights on. That's $138 billion of new debt that will be issued at higher rates. The Nikkei is down 8% from its July all-time high. Toyota, Sony, Panasonic, all getting crushed on yen strength and margin compression. Real wages have now been negative for 29 consecutive months. Imported LNG is eating the population alive. The BOJ is in the ultimate policy trap. Hike rates and you blow up the fiscal budget, hold rates and the bond market hikes for you. Either path ends the 3-decade experiment in free money. The yen carry trade, the $3 trillion invisible rocket fuel. For 20 years, institutions, hedge funds, Japanese housewives, and sovereign wealth funds borrowed in near zero yen and plowed the money into US treasuries, Nasdaq 100, European high yield, emerging market debt, private credit, and yes, Bitcoin. Notional estimates range from $1 trillion to $4 trillion. When the yen moves from 160 to 155 to 150 to maybe 140, that trade reverses violently. Japanese lifers repatriate capital, demand for foreign assets collapses, global yields spike in sympathy. We saw the preview this past summer when the BOJ merely twitched, and the Nasdaq dropped 12% in 3 trading days. That was the dress rehearsal. The main act is happening right now, and it's only getting started. Federal Reserve, the hawkish pause that just cracked. October 29th meeting, 25 basis point cut, taking the Fed funds range to 3.75–400%. Markets priced in 5 more cuts by the end of 2025. Powell's press conference, we are not on any preset course. November 19th, FOMC minutes. The committee was split 9-10 on the October cut itself. Several members wanted 0 cut. Many now believe December should be a skip. Then New York Fed President John Williams, literally Powell's number 2, the guy who runs the most powerful regional Fed, goes on Bloomberg TV and says, quote, "I'm open to considering a rate cut at the December meeting." CME FedWatch flipped from 45% probability to 80% in under 48 hours. Treasury yields dropped 15 basis points across the curve. Growth stocks ripped. The dollar rolled over. Risk assets caught a bid. December 18th just became the single most important macro event of Q4. But the real explosion is coming in May 2026, when Jerome Powell's term officially expires. President Trump has already started floating names. Kevin Warsh, former Fed governor, Volcker disciple, wants 5 to 6% rates to crush inflation for good. Christopher Waller, current governor, data-dependent, but voted against the last 2 cuts. Michelle Bowman, the only current governor who has dissented multiple times for tighter policy, also crypto-friendly. Scott Bessent, pro-Bitcoin Treasury Secretary candidate, who would push for a dovish replacement. If we get Warsh or Bowman, expect higher for longer on absolute steroids. Growth stocks, small caps, carry trades, and Bitcoin get punished hard. If we get a certified dove or Bessent pulls strings behind the scenes, markets will front-run 200 basis points of cuts in 2026 to 27, and every risk asset from here to Mars will scream higher. The next Fed chair appointment will be the single biggest liquidity event of the entire decade. Global Central Bank Sweep, ECB, Christine Lagarde, all but promised rate cuts starting December or January. Markets are pricing 100+ basis points of easing in 2025. PBOC just cut reserve requirements again, floating 3 trillion yuan in special treasury bonds skewed toward consumption subsidies rather than infrastructure. BOJ still pretending the policy rate is 0.50%. The 30-year bond market just set rates at 3.38%. Guess who's actually in charge? And the CPI nuke that nobody saw coming. The US Labor Department officially canceled the October CPI inflation report. The 18-day government shutdown killed price surveys across retail, housing, energy, and services. The data is gone forever. No backfill, no estimate, no revision later. November CPI is delayed until December 18th. That means the Fed meets on December 10th with 0 fresh inflation print. They are literally flying blind on the single most important data point for rate policy. Markets are pricing an 80% chance of a cut anyway. That's not data-driven monetary policy. That's hope, prayer, and front-running. Pillar 2. Fiscal. Fiscal is the only printer still running at full throttle. Japan, 21.3 trillion yen economic stimulus package, the largest since the COVID era. Breakdown, 2.7 trillion yen in direct tax cuts, 20,000 yen per child in subsidies, rice vouchers for low-income households, raising the tax-free income threshold by 1.3 million yen, all designed to fight deflation while bond yields explode. This is classic late-cycle fiscal juice trying to offset monetary tightening. United States. The Treasury is rolling over $550 billion per week in the Treasury General Account just to ensure there is never a failed auction. That's not liquidity management. That's survival mode on a scale we haven't seen since March 2020. Atlanta Fed GDP now just upgraded Q3 real GDP growth to plus 4.2%. Component breakdown, personal consumption plus 3.5%, fixed investment plus 6.9%, government spending 5.3%, net exports Barely dragging, we are running hotter than any single quarter during the 2021 stimulus binge. The economy is absolutely on fire. The Fed is officially behind the curve. Again. Geopolitical wildcard. ABC News is reporting that Ukraine has agreed to the full terms of President Trump's peace plan to end the war with Russia. If this holds, and early signals suggest it will, we are looking at defense stocks rotating out European energy volatility, collapsing risk-on sentiment globally, potential reallocation of NATO budgets into domestic infrastructure, war ending is the ultimate fiscal tailwind disguised as geopolitics. Pillar 3, sentiment, late cycle euphoria with hairline fractures appearing everywhere. American Association of Individual Investors. Weekly survey, bearish sentiment spiked from 36% to 49.1% in 1 week, one of the fastest jumps on record. When more than half of retail is bearish, that has historically been a decent contrarian buy signal. CBOE, total put/call ratio, flipped above 1.3. The heaviest put buying in months. Classic hedging behavior. VIX closed the week above 20 after touching 9 earlier this year. Fear is back on the menu. AAIM exposure index still over 100%. Active managers are leveraged long while price stalls, negative divergence, screaming caution. Bank of America Global Fund Manager Survey. Highest equity overweight since January 2022, cash levels at all-time highs, textbook crowded trade. Citi Panic Euphoria model, deep in euphoria territory. Historically, a reliable 12-month forward negative return signal. CNN Fear and Greed Index at 84, extreme greed. Yet junk bond spreads are at cycle tights. How do we square that circle? Simple. Yield desperation. MicroStrategy. STRD. Convertible. Preferred. 10% coupon on $100 par. Trading $67. 15% effective yield. Strive Citi A. Preferred launched November 5th. 12% fixed quarterly dividend on $100 par. Trading $80, 15% effective yield. Metaplanet Mercury Class B prefs. Fixed 4.9% dividend, best-in-class BTC-backed yield in Tokyo. Investors are so starved for income that they're piling into non-cumulative preferreds backed by Bitcoin treasuries. That is not bullish complacency. That is late-cycle fear disguised as yield chasing. Bitcoin-specific sentiment. Price topped 126K with zero signs of euphoria. No 100x leverage, no celebrity shilling, no to-the-moon spam. Then flushed to the low 80s. Bitcoin Fear and Greed Index hit 80, extreme fear. Perpetual funding rates flipped negative for the first time in a while. That combination, price down 37%, sentiment in the gutter, funding paying you to go long, is the definition of a mid-cycle flush. This is not the bear market. This is the shakeout before the real move. Pillar 4, Technicals SPY. Rejected at 690 all-time high, hit a low of 650, now blew through the 50-day moving average to 675 and looking strong. Nasdaq, RSI, sitting at 72, overbought territory, but still inside a rising channel with no overhead resistance. IWM, Russell, 2,000 small caps. The average stock inside AAII, the index, traded down 15% from its 52-week high. Classic rotation under the hood, while the Mag 7 holds the indices up. NVDA drops 4% on news that Meta will use Google AI chips. TSLA chopping sideways in a tight range, all the Musk-Trump political noise creating headline risk. Optimus speculation may start a reflexive move through all-time highs soon. Google quietly hitting record highs after Buffett's stake reveal, the stealth AI leader. Bitcoin technicals topped at 126K. No parabolic blow-off, no vertical candle, no euphoria. Drew down to low 80s with negative funding and extreme fear. Still sitting in the 14-year power law corridor, we are just below the middle. 14 years of data, zero meaningful trendline breaks. Deviations are noise. The power law is still the single best macro model for Bitcoin price. Adoption metrics are going parabolic. 1.08 billion on-chain addresses with non-zero balance. Daily active addresses at all-time highs. Hash rate just printed another record at just over 1 zettahash per second. That's more computing power than the top 500 supercomputers combined, all pointed at one job: turning electricity into unbreakable scarcity. Henry Ford's energy money, 1921 versus 2025. In December 1921, Henry Ford proposed replacing the gold standard with an energy dollar. 1 unit of currency equals 1 kilowatt-hour of electricity. No private banker could print it, no government could inflate it. Wars over gold would end because energy is abundant and evenly distributed across the planet. The idea was killed by bankers and buried with the gold standard. Bitcoin resurrected it 103 years later. Every single Satoshi in existence is backed by real-world energy that was irreversibly burned and can never be recovered. There is no central bank that can print jewels. Proof of work is the thermodynamic enforcement of Ford's dream. Hash rate is the modern version of Ford's hydroelectric meter, ticking higher every single day, making the money harder, fairer, and more unstoppable than anything that came before it. Is the 4-year cycle dead? Wrong framework. The halving is just the spark. Global liquidity is the gasoline. 2013 peak, Fed QE infinity. 2017 peak, China credit impulse plus ICO mania. 2021 peak, Fed printed 40% of all dollars ever in 18 months. M2 up 26% in a single year. 2025 has been range-bound because quantitative tightening is still on and real rates are positive. The halving happened, but the liquidity flood never showed up yet. That flood is loading. Possible dovish Fed chair in May 2026. Trump fiscal blowouts, full extension of 2017 tax cuts, new infrastructure package, potential UBI talk, China already preloading 3 to 4 trillion yuan in special treasury bonds. Japan will be forced to ease again once the carry unwind finishes punishing them. When global M2 growth flips from 2% to 12-15% year over year, the cycle doesn't die. It morphs into what everyone will call the super cycle. Same movie, bigger budget. Treasury alpha hits. Metaplanet, Mercury preferred, fixed 4.9% dividend, best-in-class BTC-backed yield in Tokyo, raising $150 million to stack more coins. Strive SATA preferred, 12% fixed quarterly on $100 par, trading $80, 15% effective yield. Non-cumulative, but if the C. Anthony Pompliano's rumored $400 million compensation package at the new pro-cap Bitcoin Treasury SPAC, that level of key man risk makes the entire vehicle uninvestable for anyone serious. Pillar 6. AI. Compute is the new oil, and demand is infinite. NVDA demand. Check. Accounts receivable grew $5.58 billion quarter over quarter. Backlog is exploding faster than they can ship. Tesla, Optimus version 3 prototypes by end of 2025, target price just $20,000 per unit, cheaper than a Model Y, but capable of factory work, home chores, folding laundry, pouring drinks, even Mars colony duty. Hand upgrades, 22 degrees of freedom, up from 11, 3 in wrists/forearms, already testing in Tesla factories and serving popcorn at the Hollywood Diner pop-up. Production, pilot line running in Fremont today, Giga Texas factory breaking ground for 10 million units per year by 2027. Musk, Optimus could be Tesla's biggest product ever, bigger than the car business. Shareholders approved his $1 trillion pay package, explicitly tied to deploying 1 million Optimus units. Space compute, the ultimate efficiency hack, a single 2-ton GPU rack on Earth, 1.95 tons is cooling equipment. Only 50 kilograms is actual GPUs. 95% of the mass, 90% of the cost, and almost all the power draw is just fighting heat. In orbit, zero convection, but infinite radiative cooling. Point a radiator at deep space, 3 Kelvin background, and you dump heat for free. No water, no fans, no multi-ton chillers. Solar panels the size of football fields, 24/7 sunlight above the atmosphere, zero transmission losses. Starship can loft 150 tons to orbit for under $100 million. That's an entire exaflop scale cluster per launch at a price that makes terrestrial data centers look like Stone Age furnaces. Musk is already building it. Orbital compute is coming. LLM showdown, Grok 4 versus Gemini 2.0. Grok 4 just dropped. Real-time X data integration, uncensored responses, native math/physics reasoning, faster inference. Gemini 2.0 strong on multimodality and long context, but Grok wins on truth-seeking, speed, and zero corporate guardrails. The LLM war is heating up, and the winner powers the physical AI economy. The big picture takeaway: monetary, global tightening everywhere except the Fed blinking, and Japan's bond market in full revolt. Fiscal, the only game still printing, 21 trillion yen, plus 4.2% US GDP, $550 billion weekly TGA roll. Ukraine peace deal. Sentiment, peak euphoria cracking at the edges. Yield chasers piling into BTC-backed preferreds. Bitcoin sentiment in the gutter. Bullish. Technicals, Mag 7 holding indices, small caps bleeding. Bitcoin mid-cycle flush on power law. Bitcoin, energy, money live, supercycle loading. Treasury prefers the new fixed income meta. AI, compute moving to orbit. Optimus scaling to millions. NVDA backlog infinite. One-sentence synthesis. The fiat system is redlining at 4.2% GDP with no inflation data and a cancelled CPI, but global liquidity is about to flood back in. Bitcoin is resetting on its 14-year power law, and AI is breaking free of Earth's physics. The pause is over. The flood is loading. Stack accordingly. That was episode 2 of Magic Money Macro. New episode every single Wednesday, no exceptions. If this added alpha to your week, smash the like button, turn on the bell, share it with one friend who's still sleeping on hard money and physical AI. I'll see you next Wednesday. Until then, stay sovereign.